Welcome to the Miami Real Estate Podcast. I'm Omar DeWin, your host and Senior VP of Communications for Surveyor Real Estate. We're proud to be in our 8th season, bringing you expert insights on one of the hottest real estate markets in the world, Miami. Today, we have your economic insight with Dr. Marci Rossell, Chief Economist, leading real estate companies of the world.
Marci, thank you for being here. We've got a fun show for you today. So we are going to do some looking back and looking forward. I can't believe it. We are 25 years, a quarter century into the 2000s. So Marci is going to do a little bit of a 25 quarter century retrospective, because how do we learn about what is in the future? One of the great tools we have is looking to the past. We're going to talk China a little bit because good heavens, a lot going on there. And then we are going to do some big predictions for 2025, including, of course, all the big questions around the housing market. So, Marci, let's start with our fun retrospective. Give us the picture of the last 25 years.
All right. Well, one of the things, like Jess said, is that in order to get some sense of where we're going, I always think it's so important to ground ourselves in sort of the history. So given that it is 2025, I want to take everybody back 25 years to the year 2000, because I want you to see just what's changed and what hasn't. So if we think, first of all, like where were we in terms of politics? If you look back at 2020, who was president back then? It was Bill Clinton. Who was chairman of the Federal Reserve? It was Alan Greenspan, a name we haven't heard in quite some time. If you look back politically, in terms of China and where things were there, China wasn't even a member of the WTO. They hadn't joined the World Trading System at that point. If you look at Europe, our friends over there, the euro was not trading physically. It had already started to trade electronically, but there were no physical euros 25 years ago. Now, 25 years ago, the US economy and the EU were roughly the same size. And so that's something we're going to kind of talk about, how things have changed economically among countries, but roughly EU, US, same size. Now, one of the few things that was the same politically in the year 2020 was that on the world stage, the only world leader of consequence who was already in place at that point, who is still there today, is, who do you think? Everybody? I wish we had a little survey, but we don't.
We can. Hey, guys, throw it in the questions box.
Yeah,
Let's see if we've got any guesses.
Yeah, we'll come back to it in just a second. Of all big leaders on the world stage, who was elected in the year 2000 and is still the head of his country today? I did give it away. It's a he, not a she. So we'll just let you guys fill up, and no cheating, no AI.
No AI.
That's right, no AI. Use your own brains.
Which we're talking about later, by the way.
Your guesses.
We're getting a lot of Putins.
We're getting a lot of Putins. That's exactly right. Our dear friend Vlad, he was actually elected in the year 2000, been there 25 glorious years. And so that sets the stage for doing a little economic comparison. And I focused on the US, but I want you guys to note something globally. In the year 2020, global GDP was about $33 trillion. It's over 100 trillion today. So the size of the global economy has tripled in 25 years, lifting so many people out of poverty, particularly in China. But when things can be so gloomy sometimes it's really useful to say, hey, the last 25 years have made a big difference in terms of delivering prosperity. It doesn't mean everybody's prosperous. It doesn't mean there isn't still work to do. But sometimes it's useful to say, hey, the world's gotten a lot richer over the last 25 years. Now, if we zoom in on the US, which is my chart below, you can see that in terms of GDP per capita, so adjusted for the population, because I remind you guys sometimes that it's important not to just look at overall GDP. You got to look at GDP per person. And in the US, GDP per person has almost doubled. So while the total global GDP has tripled, in the US, roughly on average per capita, we are almost double where we were 25 years ago. So if you look at the unemployment rate, it's roughly the same. So unemployment, labor markets, they've been some big ups and downs around 2008 and around the pandemic. You saw unemployment rates spike. But in general, we're kind of in the same place we were before. Labor force participation rates, while they declined over the last 25 years, they're currently now back to where they were. So labor market's pretty much the same. Inflation, which gets a lot of attention and has gotten a lot of attention recently, is actually lower today than it was in 2020. However, we saw a recent spike in inflation in 21 and 22, something we're going to talk about in just a minute. Interesting to look at where financial markets are. So if you look at the S&P 500, it was at 1,400 back in the year 2020. It took a big dive in 2001. It took another big dive in 2008. It took another big dive in 2020 during COVID, but it currently is sitting just under 6,000. So over 3 times where it was in terms of 2020. So for our retirees out there, this means their portfolios over the last 25 years have grown dramatically. Now, what about interest rates? Because this really matters for all of us in the industry, right? Well, the 10-year Treasury, which is sort of the benchmark for the economy, was at 6.7%. It is currently trading at 4.6%. So 200 basis points lower in terms of interest rates. So that's pretty significant. And that reflects the long-term decline in inflation rates and the long-term increase in global savings as the world ages. So let's keep in mind that over this 25-year period, the world's gotten a lot older. The percentage of the population that's over 65, where Japan, of course, is a country that's on the forefront of this, has exploded. Populations are actually in decline in places like Japan, in Germany, in Italy, now in China, a trend we're going to talk about significantly. But because there's this giant pool of global savings as people save for old age, it's put downward pressure on interest rates across the globe. So we're seeing the 10-year Treasury rate, which is lower today than it was 25 years ago. And of course, mortgage rates, which have been on quite the ride for the last year. But again, this is zooming out and getting a long-term picture. Mortgage rates today are 100 basis points less than they were 25 years ago. Now, what about home sales? Interestingly enough, existing home sales were running at 5 million back in the year 2000. Now they are less than 4 million. So fewer homes being sold, a 20% decline in the number of homes changing hands every single year. Even though mortgage rates are down and even though the population is higher today than it was then. So this is a real puzzle, something that I think is worth sort of, keeping in mind as we talk about what's likely to happen over the next year. And then finally, the last thing, which is the big puzzle for economists everywhere. Given all these things that I've shared with you, higher incomes, higher GDP per person, no meaningful deterioration in labor markets, a lower inflation rate, a higher stock market, lower interest rates. Why is it that consumer confidence peaked in the year 2000 and has been on this so steady decline so that today it's sitting at 74? So that's a meaningful decline. And if I just popped a chart up, you'd see that consumer confidence has been on the way down, on the way down, on the way down. I don't have a chart of this, but it goes on the way down. It took a real dive post-pandemic, and that big dive post-pandemic has been attributed to inflation. So that spike in inflation up to 8% in 2021 and 2022, we now know, economists have kind of looked into it, and what we find is that people don't forget inflation quickly. It decays in terms of the effects on people's perceptions by about 50% a year. So any bout of inflation has this really long lag in terms of the way that it influences people's perceptions of the economy. And I'll put a link to that particular paper in kind of the show notes, the things that Jess circulates later on, because for those of you who sort of care about these sorts of things and deal with consumers every day, in some ways, you can see there's a significant disconnect in people's minds between the reality of the economy and the way that they feel about the economy. Now, I'm an economist, so in my mind, that's a sort of moment for arbitrage, so to speak, because if people's perceptions are at sort of odds with reality, there's an opportunity in some place for things to be mispriced. And I think that's the moment that we're kind of in right now. So that kind of gives us a review of the last quarter century, kind of where we've been. And we can talk a little bit more about some of those things, but that kind of is what's been going on.
Phenomenal, Marci. And we're going to look forward here in just a minute. Actually, we're going to start, though, for the U.S. housing market. Let's start with China, though, because China is a big factor, I think, globally for what will be happening in the next year. So let's start our looking forward with China. Talk about the implications for China right now and what the big question marks and factors are that are going to be causing some ripples.
Absolutely, because as I sort of stated early on, in 2000, China had not joined the World Trade Organization. So in the year 2000, China was pretty much a bit player on the world economic scene. And I would argue that when we look back historically, the last 25 years have been sort of all about China, growth in China, the strength of the Chinese economy. Elections in the U.S. have swung one direction or the other, depending on the perception of the threat from China. But certainly, Americans had sort of ingested this idea that the Chinese economy was this powerhouse and that eventually it would overtake the U.S. in terms of size. So predictions 5-6 years ago were all about this is going to be a year that the Chinese economy overtakes the U.S. economy. Well, every once in a while, I like to point out that I'm right because that's just kind of who I am. And I never really bought into that narrative that the Chinese economy would ever exceed the size of the U.S. economy because fundamentally, they do not share our strengths. And our strengths are built on rule of law, strong property rights, and a government that respects those things. And you will never, to my dying day, get me to believe that authoritarianism is a better economic system than democracy, period. And I never believed it. And I'm going to show you a chart right now that proves, at least in this moment, that I was correct. Because the following graph, shows you over the last 10 years, including the pandemic, that the U.S. economy in terms of GDP has pulled away dramatically from the two closest economies to it, the Eurozone and China. Now, this graph's a little bit hard to read, so I'm going to sort of pick it apart for you. China's the blue line across the bottom. Now, you can see across that blue line that Chinese GDP was negligible from 1980 till about the year 2000. Now, once China joined the WTO and sort of integrated itself into the world trading system and kind of became the world's workshop, so to speak, where ideas were generated in the US and Europe primarily and Japan, but then the production of those things were outsourced to China because at that point they had a large labor force. They were enjoying that demographic dividend of lots of young people pouring into labor markets, and they had yet to see their population decline and their sort of the demographic sort of disaster that is now unfolding. So the dividend has turned to disaster. But while the dividend was paying off of a one-child policy that exploded the working age population for a certain period of time, the Chinese economy grew very rapidly. And so back in the 2000s, as China was growing, it became very fashionable to say that China was going to overtake the U.S. in terms of size. Well, that is simply not what's happened. Remember that I pointed out in 2000 that the EU and the US were roughly about the same size as well. But as Europe's economies have struggled with debt crisis, with population decline in certain places as well, the Eurozone is kind of flattened out. And the gap between Chinese growth and US growth in terms of overall size has begun to widen again. So I think this is the chart that drives the next 25 years, because we have to understand that demographic dividends, so to speak, become demographic disaster when populations begin to decline. And Japan is on the forefront of that. I saw an article the other day talking about the real effects when your population goes into decline include things like no more mail on Saturdays, because in Japan, there's no one to carry the mail on Saturdays. Entire municipalities are literally disappearing because their population simply dies. And so this is a struggle that Japan is already facing, Italy's facing, Germany is facing, and China is facing in a way that the world has never seen. There's a fascinating article in the December version of Foreign Affairs that talks about the coming demographic disaster in China. By the year 2100, China's population will be half of what it is today. Take that in, everyone. By 2100, China's population will be half of what it is today. Now, I will not live to see that, but my grandchildren will. Now, I don't have grandchildren yet, but I'm going to. I'm optimistic. This is the year, right? My grandchildren will live to see this development of a country whose population falls by half over the next 75 years. So this is why their economies were never destined to overtake the US. They will grow old before they grow rich. And it's a sad development for the entire world. I want to be very clear about that. I am not excited about this at all. I am not sort of saying sort of the trumpet of the US, so to speak. There's no exciting, this is not an exciting development. This is a problem that will need to be overcome, and we need to understand the realities of it as we look into the future.
All right, Marci, thank you. Dire, but fascinating. Let's look at 2025. Hopefully less dire, but also fascinating. We're getting some questions in, and I am happy to say that, guys, I think we are about to answer all of your questions in the next 15 minutes. So let's start with obviously the big U.S. question, which is new year, new administration, new policies. Talk through some of the biggies in terms of what you think are going to be moving some levers for us.
Sure. So last episode, we spent a lot of time talking about how financial markets are reacting to a new administration. Because you guys have heard me say before, I'm not the world's best forecaster. I don't really believe in forecasting in the technical sense. Now, I am the world's best dressed forecaster.
Yes, you are.
Yeah, I'm the world's best dressed, but I'm not the world's best forecaster. Financial markets, the stock market and the bond market, they are better forecasters than anyone else. They have all the information. They predict the future. So financial markets, stock markets rallied significantly on the election news. Bank stocks in particular rallied on the election news. Bitcoin rallies on the election news, but treasury bonds didn't. In fact, they went the other direction. So what does a rising stock market and higher interest rates tell us about policy over the next year? And in particular, the US dollar sort of squares all of this because it's seen a very strong increase as well. So what I think sort of all this is telling you is that the likelihood of tax cuts is pretty high. No surprise there. Recent research on stock prices suggests that every 1% decline in the corporate tax rate results in a 1% increase in expected earnings over time. So naturally, this is good for stock prices. The effects of deregulation, the second economic pillar of the incoming administration, are not so easy to discern. based on stock prices. But I will say this. The banking sector is expecting pretty massive deregulation. That's good for bank stocks, right? And so we're seeing stock prices for banks in particular do very, very well. But remember that banks also do well when there's a big spread between short-term rates and long-term rates. So whenever banks can borrow money short at a low rate and lend it lend it long at a higher rate, this is great for bank profits. And so I think the rally in bank stocks is more indicative of the interest rate outlook, which is not dramatically higher, but probably higher than what was expected last year. So this idea that interest rates were going to continue to decline, markets are not buying into that. They are expecting higher rates, perhaps even a 10-year treasury as high as 5.5%. So 100 basis point rally. Now, why would that be the case? Well, higher interest rates are the result of higher inflation. And so inflation is proving particularly sticky. The last inflation report, which came last week, was that prices are still rising at a 2.9% rate. So we haven't gotten to 2%. We're still 2.9%. So we're not to that 2% target rate yet. And tariffs and enhanced deportations are inflationary policies. And no magical thinking around economics is going to change that. So you've got really a split in terms of policies that are business promoting and policies that are business harming. And so that split is being reflected in the rally in stock prices, but also the decline in the bond market that's leading to higher interest rates. So, and the dollar and the rise in the dollar is reinforcing that higher interest rate picture.
So talk about the two prongs here that are really sort of interest to our particular audience. In terms of the effect, particularly with the bonds market on mortgage, what we're going to be seeing there. And then also we're getting a lot of questions in about two of the biggies that are implicating inventory for our markets, which are who's going to hold the hammers with some of the deportation stuff going on, and also on tariffs in terms of just raw materials for building, and what we'll be looking at in 2025 for those.
Well, it's just hard to make the case for a positive outlook under those circumstances. But I will say this, markets are forward looking. And so I don't expect mortgage rates to rise above where they are today. I believe they've actually priced in some ways, the worst case scenario. So I don't expect mortgage rates to go to 7.5, quite frankly. I think 7 is where they stick. And 6 months ago, I was saying we could probably see 6, maybe 5.5 next year, but not under enhanced deportations, which raise labor costs. And by the way, we're already seeing this in Florida in agriculture. So we know what the reality looks like. And then secondly, depending on where tariffs go, you're going to see a one-time increase in inflation. If you raise them all at once, you see a one-time. And if you go with the graduated approach that is sort of making the headlines, but again, everything right now is all talk. And so really, I hate to even speculate based on rumor, but I'll do it. There's basically two ways you can go. You raise taxes on day one, you raise tariffs on day one, or you raise them by 10% and then 10% and 10%. Either way, you get higher inflation and higher interest rates. So I think mortgage markets have already priced in worst case scenario, quite frankly, in terms of mortgage rates. Now, in terms of inventory, it will all depend on whether there are 300,000 people deported in a year or 1 million people deported in a year. And all we have to look back on is history. And so historically, in 2016, 2017, 2018, 2019, there were roughly 300,000 people deported every single year, which, by the way, was less than the number of people deported during the Obama administration. So deportations actually declined during the last Trump administration from where they were during the Obama administration. But if the worst case scenario from sort of a immigration point of view does develop, if it is true that 10-15% of the workforce is undocumented in construction, then there's just no way around those economics if you succeed in deporting 1 million to 2 million people per year. I think it just, there's no good. I don't see how you sort of, make the case for a good development, so to speak. Maybe you get a little easing in inventory at the very bottom because you've deported some homeowners, but I just don't think that that's going to swamp the effects of what, on supply overall, particularly in a supply constrained environment. However, I'm going to say one positive thing. I was heartened to see in the new director of housing and urban development in his Senate confirmation hearings that he expressed the fact that housing inventory was the biggest problem sort of facing the housing market right now. So at least someone's aware of the problem. I will say that that's good news. I will give it that for sure. For sure.
There's more good news, actually, just in terms of sort of an immediate factor, immediate being the next maybe 24 months, which is what you've referred to as the 65 peak, I believe.
Sure.
Talk about what that means.
Let's not gloss over that, because what I do want to leave you with is sort of, there are a couple of big, I will say, wow things that are hitting the economy right now. And so before we sort of, sign off on this, and given that this is kind of the big picture outlook, one of the big wow things that I read recently is that this year, the year 2025, is peak 65 for the U.S. economy. So the U.S. economy is aging. The U.S. is aging just like every other country on the planet. But this is the year where 4 million people will turn 65 this year and next year. So this peak 65 has real implications for your business. This is the year where seniors, the peak senior, will be on the move. Now, long term, it means that becomes less and less important. But for this year and next year, this is the sort of second home and retirement relocation peak for the economy. So that's sort of the first wow thing, 4 million people a year. The second wow thing is the demands on local utilities from artificial intelligence. So I spent a lot of time talking about AI, about its importance to the economy. But I was blown away when the report came out that Microsoft is bankrolling the reopening of a portion of 3 Mile Island, and is doing so with the intention of buying every single bit of the power that nuclear reactor produces to use for AI alone. The power needs for these data centers are enormous. They're going to put enormous stress on the U.S. power infrastructure. And the next 4 years will really matter in terms of how do we build that out in a way that can sort of grow our needs. So that's the other big wow thing. And then finally, like I said before, the fact that the Chinese population will be half of what it is today in the year 2100. So AI, China, housing, immigration, these are all big topics, not just for this year, but for the next 25 as well.
Thank you so much, Marci, for being with us for another year of incredible insights from the world's best economist and also, yes, the best dressed economist in the world.